Good afternoon. Welcome back to my YouTube channel, Goofy Investing, where we talk about investing in the stock market. Hope everybody's been enjoying their week. We're going to go through a series of some analysis as it pertains to the market, and then I'll review a stock that I'm looking at, and I'm probably going to end up buying here. But without further ado, let's get into some analysis and some things that I'm seeing. So as you can see, I got the S&P 500 pulled up, and yeah, as you can see, we're at all-time highs on the S&P. If we go to the CNN Fear and Greed Index, we're at a greed level. So I think that this is probably the only useful tool that CNN has to offer. So I mean, as far as the market sentiment is concerned, I mean, there's some euphoria. The market's feeling good. Equities are being bought up, and this S&P 500. This is a large cap. The S&P 500 is the largest 500 companies in the U.S. So, yeah, that's an indicator of something. So, let's look into some analysis and research. All right, this is Yardeni research. I periodically go in and assess some sentiments and valuation levels in the market, and I like to look at these analysis and help guide my way forward. So as you can see, we have these are 4 PEs. These are 4 PE metrics, and you got the S&P 500 on the red, and you got the 400 mid caps in the blue, and in the green you have the S&P 600 small caps. All right. So, and then you have your mega caps. All right, the Googles and Amazons and all those. All right. So as you can see, the 500s, the mega caps are up in valuation of 4 PE metrics. Then you have the S&P 500 in general. And then you have your mids, and then all the way at the bottom you have the smalls, which are trading at about a little over 14 times forward PE, as averse to your large caps that are trading around a little over 20 times forward PE. All right, so that's something to consider, and that is why. Let me pull up my portfolio. This portfolio, I do have some large cap exposure. I've decided that I'm going to tactically shift into mids and smalls. I'm gonna hold Palantir, and that'll maintain a hold for a large cap, my one large cap for the portfolio. But Tesla and PayPal, I'm gonna end up selling Tesla. And it's based on some valuation metrics, and it's a decision that I'm making for opportunity costs. There are some management, I am having some bearish sentiment towards management, but so I'm not going to get too much into that, but that's part of the reason why I'm going to end up selling Tesla. I'll make another video about it later probably. And these PayPal options, I'll consolidate that. And with the proceeds from these sales on these options and that Tesla position, I'm going to be positioning into Navitas and this company that I'm going to reveal here shortly. All right. So Navitas, I'm really taking my time building that position up. I got plenty of time to build it up. They're not scheduled to be profitable for a little while, and that's one of the reasons why the stock is getting a little bit of sell side pressure, and there will probably be another dilutive round happening with Navitas. So I'm just going to take my time building that position up, but this next stock that I'm going to reveal, I may have to aggressively build that position up. All right. As you can see, the portfolio is at around 86 G's of value, and that fluctuates from 88,000 to sometimes down to 82,000. So wild swings. And you see the cash position here is low, even though the valuations are high. Um, my cash position in this portfolio is not going to be a substantial high position until I'm hitting six figures in the portfolio. Then I'll consider a reallocation of a percentage of how much cash I want in the portfolio, as averse to how much of my liquidity I want working for me as far as equity and all. So that's something to consider. So yeah, until this portfolio, until I get a couple more positions built out, get this portfolio over 100 G's, is going to be a low cash position going forward. Even though I am anticipating some market turbulence, probably in August, September timeframe. But who knows? I could be wrong. I don't have a crystal ball. All right. So let's talk about what company I'm thinking about buying here pretty shortly. All right. And we'll do the little drum roll. Let me get my editor. And thank you. All right. Pull it up. Let's see here. That's right. Okay. Upwork. This is the company that I'm looking at. I've identified this as being undervalued. Everything checks out. There's some things that I still have to look into, and I'm still doing a little more analysis and such. But for the most part, I've listened to the conference call, looked at a bunch of the ratios, and I mean, this is looking like my next position. All right. I'm not 100% sold on it as far as getting this thing built out right away, but I'm about 90% there. We'll just put it at that. Probably expect me to be buying this thing pretty shortly. How heavy will depend on some price action, but let's get into it. Upwork is a company that facilitates a freelance platform for employment purposes. Well, I guess anti-employment, because these are freelancers, okay? So they don't get traditional W-2s, all right? Big corporations will go on to their platform, hire these freelancers, or not even just big corporations, but anybody can go on the platform, hire these freelancers for specific jobs. And in these specific jobs, they come to an agreement on how much is paid for the job or what have you. And then the job's done, they get paid, and that's it. They move on to the next, all right? So that's pretty much the idea, all in a nutshell. This company is a United States company, and they're headquartered in San Francisco. Their market cap is right now currently 1.58 billion. Because their market cap is under 2 billion, they are considered a small cap company. And I'm positioning my portfolio to mids and smalls. I think this company deserves to be a mid-cap company, but it's currently trading as a small cap. So it is technically a small cap right now. So the chart, looking at the chart here on a max, we had that peak euphoria in 2021, but everything started to come back down to earth here shortly or recently. Let's look at some of the metrics. Bear with me. Let me pull up something real quick. Here, give me a second here. I'm trying to. Okay, so we'll pull this up. You remember this Yardini chart that I pulled up earlier? On an average, the S&P 600 small caps are trading at a forward PE of 14.7. All right. Upwork is currently trading at a forward PE of under 13, 12.98. Okay. So right off the bat, Upwork is trading cheaper than the S&P 600 small caps on an average. All right. So that's one thing to consider on that metric. They're undervalued. Let's go to another metric. So we'll go to earnings. and I'm a growth investor, remember, but it's not always about, how much growth you're getting, it's how much you're paying for it, okay? So on the peg, all right, on our forward PE, we got, we're projected 12.98 on the forward PE on how much earnings we're projected to pay for this year as an investor. Let's go down to the revenue. How much revenue growth am I getting? 12.98. The same thing. All right. So the revenues are set to grow 12.98%. And for a forward PE price, as of right now, it's a forward PE of 12.98. That means the peg, the price to earnings growth, is exactly 1. I'm getting a 1-to-1 for that growth. All right. So this tells me that the growth is not priced in. All right. So this is cheap. All right. On a growth metrics, for the growth I'm getting or I'm going to get, it's looking good as long as they hit their targets and they actually grow that percentage. Next year we're under the peg of 1, and then the subsequent year it just gets better and better, and then when we're starting to get into 2027, it looks like the peg is like half, like a 0.5 ish. All right, if these analyst estimates are correct. All right. And we're and from for the next until up to the next 3-4 years, we're projected double-digit growth. I'm feeling it. I like it, and I like the sector, the business sector here, and freelance work. I'm very bearish on employment and corporate side employee retention rates. I'm very bearish. I think a lot of the work consumer has pretty much a lot of people have lost faith in working for corporations, and because people will just get cut like nothing and so forth. So I see a lot of growth potential in this category. All right, let's go to the valuation. They got net cash on the balance sheet. Checks out to me. They're profitable. We'll go back to the financial statements. Revenues looking good. Got good growth happening there. Um, actual shares outstanding, they actually will go to a quarterly aspect. We'll look at, bear with me. So you see the shares outstanding went down from the last quarter. They're starting to buy back stock. All right. So they're starting to buy back stock at these levels, which is another good sign. We'll go to cash flows. Net income, they're positive. They're a positive company already. All right. So we go back here, go back to earnings, go back to earning estimates. Actually looking at their EPS, their projected EPS, explosive growth. All right. Expected 92 cents this year and $1.09 next year. The company is trading at $11.91. So within the next year, we're going to be pretty much like earnings yield is going to be about 10% on a forward rating for next year. So that to me is, I like to see that. That's a lot of value right there. And the actual EPS growth is set to grow dramatically. Not too crazy, but your 20 plus percent, upper teens EPS growth. And if they keep buying back shares, they'll easily beat that. All right. So, that's another thing to consider. This is the management. I mean, management's been doing a really good job of, creating value in this company. Even though from an IPO standpoint, they're still losing it. But I mean, there was peak to trough. I mean, this is just how it works. But from a valuation perspective, I'm liking this company. I want exposure into this small cap. I think the TAM, the total addressable market for this thing, is crazy. This has the potential. This has the potential several years or decades down the road to 50 to 100x. This can be a large cap company, like a big one. Dare I say, 200 billion, 400 billion market cap company. If they execute properly and they find the niche, and because this is a company that drives up, is a business model of scales of economy. All right. So, I definitely want exposure into this company. All right, and this is going to fit real well into and it's hard to get in my portfolio. All right, I'm very I'm very picky about everything. If you're going to be a big player in my portfolio, everything's got to check out. Now, I will say this: what's one thing that I have to look into, that's pretty much stopping me? I think that at these prices right here, I'm good with just buying it all out for my whole position. I think it could go a little bit lower. And I think one of the reasons why it's trading so cheap is there's not an established freelance large cap company, that analysts and Wall Street analysts can project and model after from a valuation perspective. So there's an arbitrage disconnect in the modeling of what Wall Street's pricing this thing in. And that equates to more alpha for me as an investor because I'm able to take more risk. And a lot of these companies or a lot of these institutions are not going to be able to. So even there's one competitor, we'll go there. And that competitor is actually Fiverr. Let me edit the symbols real quick. We'll go to peers. We'll take all of these out. And Fiverr, we'll do a little comparison. Fiverr is the competitor. And we'll go from a valuation metrics, all right, or from a trailing PE, or Ford Gap or Ford Gap PE. They're trading at 3 times more than Upwork, and Upwork's growing more than Fiverr, pretty much across the board, except the 5 year. But it's irrelevant. On all of these metrics, Upwork has pretty much got Fiverr. Fiverr's got a little bit better balance sheet, but they handle a little more niche, smaller jobs as opposed to Upwork. We'll go to profitability on Upwork. That gross profit margin is looking really good. It's very attractive to me. The company's guiding adjusted EBITDA off 35% in the next 5 years. So net income, I could see net income margin exploding and expanding too. So I don't know how long this is going to stay cheap, but it's definitely caught my eye. Another thing, just one thing that's stopping me is some insider activity happening. There's been nothing but a bunch of selling from the management, so I got to look into that. We'll look into this. Even the CEO has been selling a lot, and that doesn't necessarily mean that the company's bad, because the actual shares held in comparison to how much she's selling at the frequency is kind of irrelevant. I think a lot of the time it has to do with the compensation package. A lot of these CEOs aren't paid a big salary. A lot of their compensation is through the stock. So they have to, and with these vesting periods that have happened, the IRS hits these CEOs pretty hard, and they're in California, remember. So there's even more taxes that need to be paid. So I'm not really too concerned about it, but that's just something that I've noticed. All right. But yeah, that's my take. I hope you all got value out of the video, looking at different metrics that I look at, and in different ratios, and looking at value in different angles, and deciding what play I want to do. So nothing's financial advice. This is just how I do things. Hey, consider looking at my Patreon. I got exclusive content running down there all the time, where I talk about even more different angles that are exclusive, that I post on there for exclusive content. If you're getting value out of the channel, subscribe to the channel, help a brother out. This is the underground. It's a real small channel, and I'd like to grow it a little more. With that being said, I hope you all enjoy the rest of y'all's weekend, and have a good day.